Hi everyone, my name is Hamish Shepherd from Cruncher's Alternative Accountants. One of the questions we actually get asked quite a bit from clients, and especially new clients as well, is how much money should I be paying myself as a salary through my company, my limited company. So I thought I'd just do a quick video and a quick demonstration on what you should be taking out. These are based on 1920 figures. However, if you do want to get the most up-to-date figures for 2021, then please get in touch. Remember to subscribe to the video channel as well. We'll be taking out videos all the time. And if you find it helpful, or if there's a question or anything like that, then also put that into your comments. Excellent. So what is the most tax efficient salary to take out? As I say, my name is Hamish Shepherd from Cruncher's Alternative Accountants. Please share this, or if you know anybody that would be interested in it, then please get in touch. So if we kick off, so what I thought I'd do here is give you 5 different scenarios and basically show you what tax you'd pay for each one. So example 1 here, what we've got is we've got a company here with turnover of £100,000. We've got costs of £60,000, salary, employer's national insurance. In this case, we're assuming that we're going to take out all the money via dividends. That gives corporation tax at 19% of 7,600. And we take out dividends of 25,000. Those dividends, when taxed in your self-assessment, would then be an additional £788 of tax. So if you were to take out £25,000 in income from your company and it was all via dividends, then the total tax you'd pay, because you can only pay dividends after corporation tax out of reserves, would be £8,388. Now, the one thing to remember there is, as I say, it can only dividends can only be paid out of profits after tax. So as a result, if you don't have any profits in your company, just bear in mind that you won't be able to take out dividends, and that has a knock-on effect to potentially, if you're looking for a mortgage or something like that, and you don't have enough profits in the company to actually justify that mortgage, you might end up having to pay yourself a higher salary and taking a little bit of a hit on the tax on that. Now, if we were to flip it around, instead of dividends, we were going to take out salary, then using the same scenario as before, £100,000, £60,000 of costs. In this case, you would actually have an extra £25,000 of costs coming through because you're paying salary out, and that's tax deductible within the company. However, on the flip side, because it's over the lower limits for national insurance, you would have employer's national insurance to pay as well, and that's where this £2,259 comes from. This assumes that you've got no employees, by the way, and I'll show you an example with employees later on. That leaves a net profit of £12,741, tax of £2,421, that's corporation tax. And again, you're taking out your salary, £25,000. Your tax there on that salary would be £2,478. So this is what you'd be personally paying, £1,964 in employees' national insurance. So the total tax there is £9,122. So as you can see, it's quite a bit worse off than just taking out dividends. And that's purely down to employers' national insurance, or pretty much down to employers' national insurance. The next scenario we've got is the one that we would do if it's a director-only company with no employees. And what that is we take out 8,000, and remember this is 1920 figures, it will change in 2021. That's taking out a salary up to the lower national insurance limit of £8,632. If you want to find out what that limit is, if you just put national insurance limits 2020, 2021, and go to the HMRC website, it will show you what that equivalent limit is for 2020, 2021. The salary means that we're paying slightly more in corporation tax. However, the advantage with this NI limit here, this 8,632, is it doesn't attract employers' national insurance. However, the 8,600 is still a tax deductible expense within your limited company. To get back to the 25,000, that means that we would need to take out £16,368 in dividends. So that gives us our 25,000 again. So we're still taking the same amount of money out of the business. And again, the dividends on that, we get taxed at £788. What that means is that your total tax take for £25,000 would be £6,747. Now, if we bear in mind that it was £9,100 just by salary and £8,388 just taken up by dividends, you can see that there's quite a big saving there, £6,747. And again, it's because you're taking roughly 20% of the £8,632 is where you're making that saving, because that's getting deducted against the corporation tax, but you've got no employer's national insurance to pay. Example 4 is one that we get asked quite a bit, and it is, Hamish, why don't we take up to the personal allowance limit? And there are cases where that is advisable. Again, sometimes if you don't have dividends to take out, then it might be better taking a higher salary. Or if you've got employees, then it would be worthwhile taking up the personal allowance limit as well, and we'll show you an example of that in example 5. So again, if you took up to the employer's, sorry, your personal allowance limit, that would be 12,500. That would then attract employer's national insurance of £554, tax of 5,120, and it would attract tax on your self-assessment 788 and 464. So the total tax take for that is 6,925. That's what you would get taken off as tax. Now, if we look at the previous example, you can see it's not a huge amount in it, but it is about, what, a couple £100. So that is why normally, if you've not got employees in the company, we would suggest taking the £8,632 out rather than the full £12,500 out, because there is a couple of £100 in tax savings. Now, it does actually change if you've got employees, because basically what happens with employees, if you're a small business, you basically get employer's allowance, basically, which means that you don't pay national insurance on the first chunk of salaries that you pay out. And what that basically means is that if you did have employees, you'd be able to take out the £12,500 without actually having to pay employers national insurance. And tax works out here, tax and employees national insurance 23,748, 6,477. So if you've got employees, yes, it's worthwhile taking the £12,500, because you can see it's a couple of £100 of a saving on taking the 8,632. So in summary, this is basically where we're kind of sitting at the moment. If you've got employees, then what you would end up taking, and apologies, my spelling's not been great here. If you've got employees, then you take up to 12,500 as a salary, and that would then 12,500 as salary, 12,500 as dividends. If you're taking out 25,000 out of the business, that would cost you tax of 6,477. If you didn't have employees, then what you do is go up to 8,632, and the remainder would then come out as dividends, and that would mean that you're paying tax of 6,757. And then you can see it going all the way up to, if you're just taking salary out for £25,000, it would be £9,122. So you can see actually, you know, there's a huge difference between £6,477 and £9,122. So just make sure that you get that right. Make sure you understand it. If you've got any questions, speak to your accountant. And as I say, these numbers change all the time. Things change all the time with dividends and things like that. So, you know, this is based on 1920. 2021 will have different figures in here, but the thinking is the same. However, there has always been rumours that dividends, the dividend-free allowance of £2,000 each is actually going to fall away. So that might have knock-on effects to the way that we calculate these things going forward. But again, as I say, that is what your accountant's for. So please pick up the phone. If you can't get your own accountant, pick up the phone to us, and we'll try and help you as much as we can. Okay, thank you very much. It's Hamish Shepherd, Crunchers Alternative Accountants. Thank you for listening.